G'day everyone and welcome to today's webinar. My name is Mitchell Snedden and I'm joined by the Intelligent Investor Portfolio Manager, Nathan Bell. Today we're going to be walking through the Intelligent Investor Ethical Share Fund. It is an active ETF listed on the ASX. The stock code is INES and currently we're undertaking a secondary offer where you're able to purchase units in the fund off the market, save yourself on brokerage and the buy-sell spread by going via our application. And we can then allot the units to your holder identification number via your brokerage account. So today we're going to be talking about the fund. We're going to be talking about stocks in the fund and the market as a whole. So anything we do say here is not personal specific advice. So it is only general in nature. And we do say to you to go out there and seek advice from your financial advisor if you do need to do so. Now, I'm going to hand over to Nathan Bell. He's going to go through the slides we've got prepared today, and then we're also going to be answering your questions along the way. So do feel free to make use of the question section there, the comment section, and we'll get to those as we progress through the presentation. Nathan.
Thanks, Mitch, and welcome everyone. So I'm going to focus a lot today on performance and on a lot of the stocks in the portfolio rather than just on sort of the nature of the ETF itself, where a lot of that information is on the website. But the overarching message is we've had to pay the last couple of years with poor performance versus the index because we either haven't been able to invest where the money's been made, which is the iron ore miners, for example, because of our ethical mandate. But we've also had to experience a big fall in the price to earnings ratios for our favourite stocks. So the value hasn't gone. It's still there, and I want to explain those particular stocks and why the value is still there and why I actually think the fund is in the best position it's been in since probably the COVID bear market. I thought before we got into the details of the fund and the performance, though, I just sort of worth reminding ourselves why we started the ethical fund in the first place. And it's those top numbers there that, because I was quite skeptical, as I've said in the past, about launching this fund. But when I went and did the research, we had nearly 500 buy recommendations in our subscription business over nearly 20 years. And I ran the ethical filter against all those buy recommendations. And the average return from each recommendation that passed the ethical filter was nearly 15% versus just over 10% for those that didn't pass the filter. So the thing is, the really important thing to explain is it's not necessarily the ethical filter that's the reason why those stocks outperformed. It's because they were the highest quality businesses and we owned them for the long term. And the sort of stocks that fell into that 10.1% was where we had a lot more accidents. We just had a lot more stocks that didn't work out because we thought we were getting a bargain. They looked cheap, but they were lower quality businesses. They tended to have more debt, and they weren't necessarily run by founder owners or founder-led businesses, which is what we prefer to buy. So it was really just the high quality nature and the long-term patient investing approach, which has always underscored the intelligent investor approach as to why those returns were much higher. So you took basically our process and put a filter in it to make sure we stuck with the quality businesses, because that's essentially what the ethical filter does. It forces you to buy the highest quality businesses on the market. And part of the reason last couple of years in particular, because the multiples of those great quality businesses have been coming down. And in some cases, they've been coming down from pretty crazy valuations, and we've suffered a little bit from that. But also, that's given us a great opportunity now to increase the stakes in some of those businesses I want to talk about today. I've included some numbers down the bottom there. They're not particularly important, but it just shows a much broader universe than Intelligent Investors Fund. This is the Responsible Investment Association of Australasia, and they look at a whole bunch of ethical funds and how they've performed over time. And you can see that they have outperformed, but the outperformance has come down a little bit recently. And again, I think that really just shows you where the money's been made recently in the market. It hasn't been necessarily in the highest quality businesses that are suffering from their falling price to earnings ratios as interest rates have gone up. But I absolutely think this has become my favorite portfolio recently because all the problems we've had in our other funds have been in stocks that don't pass the ESG filter. So we've had to suffer the last couple of years as those multiples have come down, but all that's done is create more value in the portfolio, and we'll get to that in a minute. Oops. So again, I won't go this in detail, but you can read this sort of stuff on the website. But there's nothing unique about our ESG filter. All we're doing is taking a generic ESG filter, taking what are industry standards for things that need to be excluded, and just picking stocks from what's left. And in actual fact, it doesn't really leave a lot, but it's actually a good thing because, again, it's forcing you to pay up for high quality, and that's really worked pretty well over time. Obviously, we had a scintillating start, which was never going to be sustainable, but now having to see some of our favourite stocks valuations come down, we've just either been increasing those or adding more of those high quality businesses to the portfolio that have previously been out of reach because they've just been too expensive. I won't go through this. I think most people know what our approach is, but I'd just like to highlight that higher insider ownership one. You could almost call this fund their insider ownership portfolio. I think about 55 to maybe even 60% of the fund is invested in stocks led by their founders. And it's no surprise really, because I think it's one of the last free kicks in the market where it's one of the most reliable guides to our performance. I know a lot of people have seen these charts before, and I'm sorry I don't have updated numbers. I wish someone would put them out. But these two charts go to 2014, and they show the performance of the stocks in the S&P 500, which is the major US index. And it shows the difference between the companies that are founder-led and those that aren't. And you can see it's just a massive gap. On the left-hand side, it's really been dominated by tech companies. And if I had those numbers up until 2023, that chart would look even crazier than what it does there, because all the great stocks that have been responsible for basically, I think, 86% of the performance of the NASDAQ over the last 12 months has been those big tech stocks which have founders at the helm or big insider ownership still. But it's not just tech stocks. The chart on the right-hand side shows that it's across industries. So that's why it's really important to us. And again, I think basically all the problems we've had in our other funds recently, something like Star Entertainment, for example, has been where CEOs don't own a share in the company. So maybe we should just be making all our funds ethical funds. So I'm going to talk quite a bit about the performance because we got off to a scintillating start and we really couldn't do anything wrong. And I think within a fairly short period, you can see sort of towards the end of 2021, I think we got out as far as like 36% ahead of the market in a really short period. It was incredible. Like it was far better than I could have hoped for. But part of that was unsustainable because it was just part of that crazy bull market we've seen coming out of COVID, where people were willing to pay any price for the great growth stocks. Actually, people were pretty prepared to pay crazy prices for just about any stock that had a bit of a growth or recovery. We saw retail valuations that have come, the retail stocks have fallen 70 or 80% for some of them now.
Yeah, I think it's important to definitely talk about this performance because looking at this chart, I know when we did the last secondary, one of the last secondary offers for this fund, so a lot of new investors came on board, and that would have been about 12 months ago. And it's been, look, not exactly the smoothest of rides for them over that time period.
No, I think that's right. And like, it's all well and good for us to sit here and say, hey, look, since inception, we're 2% ahead of the index. And if we do that forever, then we've done our job. And I think that's perfectly acceptable. But we also know that we've had people come in more recently who haven't got those returns. So believe me, we are well aware of that. And our job is to get you 2% in front of the index over time. But other than the COVID bear market, and maybe when we started the fund, actually not when we started the fund, just the COVID bear market, this is the most confident I've been in this fund to outperform, and I'm going to explain why. But I'm more than happy to put you'll see in a slide coming up, but if we can't smash the mark over the next 5 years, then I'll be more than happy to hand the funds over to someone else. And because I'm just that confident that the returns from the market are going to be much lower than what they have been recently. In fact, the market over the last 16 years has done no capital growth whatsoever. I think anyone who's owned the banks probably experienced that anyway. All you've got is the dividend yield. And I wouldn't be surprised if the next 10 years is the same because the iron ore miners have had this incredible period and we think that's unsustainable. But that's been a big part of why the market's actually held up pretty well over the last couple of years. And I think the fully franked dividends of the market, the iron ore miners make up about 23% or something of that total, and we don't think that's sustainable. And when that falls away, the market will fall away. And we all know the banks are challenged. I think the banks have got a really tough 10 years in front of them. And other than that, you're really looking at A-REITs and CSL. So if we can't beat that group by at least a couple of % over the next 5 years, then I'm not the person to be running the money. Just in terms of the recent performance, I've pretty much already explained it, but if you looked at that last 2 years in particular, where we're 8% unders per year for the last 2 years, you would have thought that we had all these huge mistakes and we've just blown up money on some really bad stocks, but it just hasn't been like that. This is the first time in my career where actually there's underlying businesses are doing great and the market just refuses to give them the value that we think they're worth. I've been through periods where we've done great. We've gone up with the market and we've outperformed. And normally we're going through periods, or at least the periods I remember, are always the really tough periods where you're going through the down cycle. And so you're buying stocks that actually aren't performing that well, but you know they're cheap and you know things are going to turn around. So everyone understands that you're underperforming because the business themselves aren't doing that great, but you just know that they're severely undervalued and things will eventually get better. But this is the first time I've actually basically had no real big mistakes in this fund, and yet our recent performance looks terrible. But the key to this is, and this is really the message I want to get across, is that you are paying us to suffer this underperformance for higher long-term returns. If you don't have these periods of underperformance, then you're not buying the value stocks and you're not going to have outperformance over the long term. So I know no one likes to be underperforming, and I hate it. Whether it was playing football or cricket or basketball in my life, I never wanted to lose, and I hate losing in investing as well. But if you don't have these periods of underperformance, you cannot outperform in the long term. It's just the price you have to pay. And believe me, I look at myself all the time and see, are we making mistakes? Are we missing opportunities that we should have made? A lot of internal thinking, always making sure that we're the toughest criticism comes from ourselves to keep ourselves honest. And in this game, you can easily fool yourself. But I look through the portfolio and just some of the stress sometimes I feel about the market and the macro environment and higher interest rates and quantitative tightening and all this stuff that sends shivers down everybody's spine. I just look at the list of their stocks that we've got at the moment. I just go, this is probably the highest quality portfolio we've ever had. And I really just don't see how we can't beat the market, given I think the market has basically spent all its bullets getting as far as it's got. And yet I look at the stocks that we own, and a lot of them are coming out with these great results, and the market's just, it's tumbleweeds. They just don't care. No one wants to own some of these businesses at the moment for all sorts of company or industry specific reasons, but that's where the value is. And the thing is, we've got to own these stocks now and suffer the underperformance. Otherwise we'll miss the recovery, and we can't afford to miss that early recovery because that's where the outperformance is.
I was going to ask Nathan, what will it take for the market to take notice of these companies that you're holding in the portfolio? And we will get to the companies as well. What will it take for the market to recognize that value?
Yeah, see, that's the thing about the market. You never know, and it could be stock by stock, or it just could be a market-wide. Maybe this, we've seen the market go up a lot in the last couple of days. Like inflation's down, and maybe the
fund is also actually up quite a bit in the last few days too.
That's right. We've had the best 3 days in the fund for 18 months, if not 2 years. We've had 3 days of over 2% returns from the fund, smashed what the index has done. And that just shows me when the market regains its confidence, it's going to come looking for the stocks that we own. But is it a stock by stock thing, or is it a whole market thing where all of a sudden people go, yep, I've been hiding in iron ore miners, I've been hiding in the banks or Wesfarmers or CSL, which ironically people thought healthcare was a place to hide, and it hasn't been anything but, or has been anything but. They'll come looking for our stocks, but I don't know when it is. I don't know how fast it happens, but all I know is because we don't know the timing, we have to own the value now. If you don't buy it now, then you're either timing the market, which is really difficult, and I just don't think we can do it. But you also miss that first 30% run in these stocks, and that's where the outperformance is sown. So if you miss it, then we can't outperform. So we have to be there now, and if we have to suffer, then we suffer. And I know people don't like that, but that's the price you pay for long-term outperformance.
And I think this ties in really nicely with the Jesse Livermore quote that you love to go back to. It was never my thinking that made me the money. It was always my sitting.
It is. And I think that's probably the difference with this fund as opposed to probably our other funds at the moment, where we have made quite a few changes recently in the other funds. But this portfolio has been pretty steady for the last 2 or 3 years. Like, we haven't made a lot of changes, and we will go through some of the changes now.
I was going to say, you've been able to bring in, the only changes that really have happened are the ability to bring in some really high quality names as they've pulled back.
Yeah, the change is basically that we've put in higher quality businesses, potentially offering higher returns, which is the holy grail of investing. So if anyone's got more questions about the performance, we'll be happy to take those after the formal presentation. But I'll just reiterate that it's unusual to have such lousy short-term performance when you're actually really happy with your stocks. I'm not going to go through this slide. This was more about sort of why the fund had performed so well up until sort of 15 months ago. That's history now. Now I've explained why the portfolio has lagged lately, so we won't go through that again. We'll actually start getting into some stocks. So you would actually think, looking at that performance, that we'd had no winners. You actually think that everything was not performing well, but it's actually not true. We've actually had some big winners. We've had Audinate's been a cracker, and we've been banging on about Audinate for years. And it's really showing its straps now. Car sales has performed much better than I thought it would. Have come out with a huge result not long ago. So that was a 50% increase in the share price almost instantly. So that was a nice one. And James Hardie's been another good stock for us as well. It's probably what I call the best cyclical business on the market. It is cyclical. The share price does jump up and down, but over time, it's sort of a bit like Macquarie, I think. That's probably another good cyclical business, but doesn't do great during the cyclical downturns, but it seems to always come out more profitable through the next cycle. And so we're more than happy to own those businesses. And it's like what Warren Buffett said, I'd rather earn a lumpy 15% than a straight, easy 10%. So we have had winners. So these have been great stocks for us. Some of the stocks we sold that hadn't worked out for us was Ansell. I think we just got into that too early. We should have been more patient, but it's suffering from the cyclical downturn and a bit of overhang from COVID. But I'm just not impressed with management. I don't think there's been a management change in the last couple of years, and I haven't been impressed with anything they've done. So even though the stock looks cheap, I got out. And again, it just comes back to just every year I'm in the market, the older I get, just the more important management is. Omni Bridgeway was another one which looked statistically cheap. Again, it had a CEO change and we decided to get out. But again, they weren't big losses. They were pretty manageable. I think they were 1% maybe, or even less than 1% losses. And the other stock that we sold just yesterday was Integral Diagnostics, which was a COVID patient, does radiology, and profit should have been bouncing back really strongly through this period. And revenue has been okay, but nowhere near what we thought. But because of staff shortages and other higher costs, it just hasn't been coming through the bottom line. And this is a company that is founder-led, but has been making acquisitions and really leveraged the business up. And I'm starting to think now that the business is leveraging up with acquisitions to hide poor-performing businesses, and that's not really what we want. So I think this is a company that probably needs a capital raising. And as we've found in this market right now, if you need to raise capital, you pay through the nose. It's really dilutive, and that's why we got really stung on Star Entertainment and the other stocks. So I don't want to be hanging around for any of those at the moment. So Integral is gone as well. It's probably a takeover. I'd say normally it was a takeover candidate at this price, but it's got so much debt that it doesn't necessarily make it all that attractive to a bigger player because it's already geared up. So again, here's one half. Or 3/4 maybe of the high quality stocks that we've brought into the portfolio the last sort of 6 to 12 months. Objective is a really high quality software company with a tremendous track record, a little bit like Technology One, which is probably better known. A lot of the work comes through the public sector. So it has a little bit of a sort of black box about it, because you need special licenses to operate businesses for the government for secrecy reasons and national security and those type of things. You can't actually see as well into the revenues for this business as what we'd like. But that said, it's not a huge position so far because statistically again, you're paying up for the quality. But it's been a tremendous business and probably one you probably haven't heard of, but a really good track record. I think Mineral Resources is another one that we brought in fairly recently. And it sort of took off, and we actually had nice gains there to start with, and we could have sold it closer to $100, and there was definitely a case for doing that. But I just really think this is one of those compounders that up until recently has gone under the radar. And do I really want to sell a stock that I believe over the next 5 or 10 years is going to be worth a lot more than it is today, even at $100? And it's down around 60 or 63 now. I just thought, what's the point of selling this? It'll be a short-term capital gain for a lot of people, so they won't even hardly have made any money out of it. And all I'll be doing then is be stressing out wanting to buy it back. Because the case for selling it was that we knew the lithium price was going to come down, but lithium is sort of a quarter or going to be a half of this business. It's not the total business. So I would rather have hung, I'm glad we've hung on to it and suffered a bit of underperformance at the moment, because it's one we want to own. And if it gets any cheaper, we'll be beefing it up.
Can I just jump in there as well, Nathan? We will get, well, I know we do get a few questions coming back to that ethical screen. We've got a company in its very name, Mineral Resources. A lot of people would presume resource businesses are screened out by the ethical screen. Can you just describe why that is in place?
Yep. So basically, lithium is considered a green energy. So a stock that I haven't actually got on one of the sites coming up, but we just bought in the last couple of days is Pilbara Minerals. It's a really interesting story. It's only a small position at the moment. It's actually the most shorted stock on the market. So it shows we haven't lost our value credentials, that's for sure, or contrarian credentials. But lithium is definitely a green stock. Interestingly, Fortescue Minerals, ticks or passes the ESG filter. It's not one we've wanted to own. We've been running the fund, but gets the tick, and the lithium companies get the tick. And the rest of Mineral Resources is it's not really a miner so much as it's more of a crushing business,
right,
doing services for other resources companies. But the reason BHP and Rio haven't passed the filters in the past is because they've had uranium mines, and BHP's also had the coal. Now, you could make an argument about the size of those businesses and whether maybe it's immaterial, but we haven't wanted to own those stocks, even though they've been a big part of where the market returns come from lately. So if there came a time where we want to own them, then we can have the argument again. But you are seeing a bunch of companies, including BHP now, making these deals, selling off their coal assets, trying to tick the ESG filters because they want funds like us buying their stock. So you're going to see more stocks actually fall into the passing the ESG filters over time, which is great for the fund because we'll have more to choose from. But that's why Mineral Resources. And the other one is probably RPM Global, the mining software company, which is its job is to help these companies be more ESG friendly and help them cut costs. So, and it's just a software company, so it doesn't do any,
doesn't do the digging itself.
That's right. So in that respect, it ticks the box for us.
And I think this is a good point of difference for the Intelligent Investor Ethical Share Fund as an active ETF on the market compared to other listed ethical options on the market. The bulk of the listed ethical options are passive. They take a screen of an index and just weed things out. But essentially here, you've got a list of companies that a human being is taking a look at. You're looking at them from quality purposes and as well as the ethical, and they have to pass the pub test, essentially.
Exactly. That's a perfect way to put it, because there is judgment involved. There's a lot of resources coming out now trying to model all these things. But one of the reasons I bring up the slide earlier in the deck normally about the insider ownership is because you can easily make the ethical stuff a box ticking exercise. And a lot of stocks are taking a lot of heat from these groups claiming to be all ethical and, trying to help out shareholders and that, when all they're really trying to do is get all the boxes ticked and trying to increase their own revenue for their own businesses or increase their bonuses for their own jobs. And what we're seeing is, for example, because we like founder-led businesses, a lot of those businesses don't tick every box perfectly for the number of women on a board or the number of independent board members, for example. Yet the value creation for these businesses is undeniable. So if you said, okay, they don't tick every single box perfectly, so you're out, you're not going to outperform and you're depriving yourself of the best businesses on the market. So no company is perfect anyway, but you've really it's obvious, some of the things that we just can't have, with the stuff we just cross out, it's no, that's just unacceptable. But we do have to provide judgment. And I like that. You should want that. If it gets to the point where we're just ticking the boxes, then you shouldn't have your money in this fund, because then we're just like everybody else.
We've got a quick question popped up on the screen here from Grant. If you reinvest returns back into your portfolio, is there any additional fees on top of normal fees? No, there's no additional fees for paying using the dividend reinvestment plan, and there's no brokerage, of course, on using the dividend reinvestment plan as well. So, Grant, if you choose to use that, there's no additional fees. Of course, you're buying more units in the DRP, which means, of course, you will be paying management fees on those units. The management fee is 0.97% per annum, and there's no performance fee associated with our units as well.
So I won't spend too much detail on a couple of these other stocks because there's other things I want to get to and still leave room for plenty of questions. But the insurance company up there, that's an insurance broker. It's a recent addition. We should have owned this a long time ago, but this is another founder-led business, and it's got a bit more growth than the purely Australian businesses, which I noticed the other two, Steadfast and Austbrokers, are starting to go overseas more, but it gives an extra growth leg to this business. And it's been, again, one of those sort of under the radar businesses that's still founder led. Dicker Data, another founder led business with a cracking track record. Maybe should have bought a little bit more of that recently. But again, we'll get another chance at some stage. And Wesfarmers, actually, I always feel like when I buy these big stocks with a W, like the Westfields and Wesfarmers and Woolies, I've failed as an investor because I feel like we should have more unique and better ideas. But the reason we bought Wesfarmers is not just because it has Bunnings, which is arguably Australia's best business, but also it's our view of lithium, which lithium is going to be in the doldrums for, I don't know how long, whether it's 6, 12 months, a year and a half, whatever. But the long-term outlook for lithium at the moment is tremendous, and you're actually getting some really nice cheap prices in the lithium sector at the moment. And we think it's the lithium part of Wesfarmers that's being undervalued. So that's really why Wesfarmers got in. Okay, so this is another key ingredient, and I've probably been talking about this for a while, but this is a big reason why I expect the fund to outperform over the next 5 to 10 years. You can see PSC Insurance Group there, RPM Global, I've just talked about. The company's getting no love. It trades on almost 20 times earnings, and yet these software businesses were trading at 20 times revenue not all that long ago. So this is a company that's doing everything right. I think people are a little bit frustrated that it's taken longer to transition to a software as a service business. Probably hasn't grown as fast as people would like, but I think this is a business that's trading around $1.50, and I think this gets taken out or acquired at some point, but there's no way this is going to get acquired for less than $2.50, I would have thought, if not closer to $3. So this is a stock I really like. Advanced Power, or PWR, this isn't cheap. It's just one we've owned for a long time. It's been trading with the small caps, so I don't expect huge gains, but another founder-led business that's more than doubled for us. Unfortunately, we didn't have it as a very big position when we started. But again, a founder-led business that's going under the radar, doing cooling equipment for motor cars. So interesting little business. MA Financial is one that is following the Macquarie playbook. And I think this could be a business that you look back in 10 years and it could be a $20 stock where it's $5 now. Obviously, it's going to take time. It's not going to happen tomorrow. But I just think this is a business that has all the ingredients. Has the right culture. It's in an industry that can grow almost indefinitely. It does asset management. So as long as you can find something to buy and you can find investors, then the growth is really unlimited. Obviously, broadband's been a good performer for us recently, and we've done well out of the small telco space over the last few years. When you see these really good small telco businesses, it's sort of a dichotomy where you see these really massive, slow-moving telco businesses at the top end, and underneath, right at the bottom, you see these tiny little businesses as they seem to sort of put things together, and they end up getting taken out by the big guys at some stage for billions of dollars. So we're really happy with Aussie. We really like management there. Again, it's making acquisitions to build a bigger business, but small telco is an area where it actually makes sense to put these assets together. Like you see a lot of businesses making acquisitions, they just make no sense, or they're just paying exorbitant prices to grow the business as fast as they can, and then they try to offload the business before it collapses under a weight of debt. But they make sense in this case. And there's one more stock there. I can't remember what it was.
It was Frontier.
Of course, poor old Frontier. Like RPM Global came out with a really good result, its best result for a while, just a few weeks ago, and basically was met with tumbleweeds and crickets. So it's a business that I think is worth multiples. Even if it doesn't do that great in the future, if it just keeps growing at what it's doing now, I still think it's worth 3 to 4 times what its current value is. And if it really, if the Pakistan business comes back over the next couple of years and we get proper full value for that as well, this actually could be a 5, 6, 7-fold return.
I'm gonna say, Nathan, you said that the underlying business results have been good. For it, once again, what's it going to take for the market to perhaps regain some confidence in Frontier?
Yeah, the RPM Global one is probably the one that stumps me a little bit more because it said like at least 2, if not 3 profit upgrades now, and the share price hasn't gone anywhere. In fact, it's actually down 25% from a couple of years ago, and yet the business is way better, far more profitable, and now trading on nearly 20 times earnings, which just doesn't make sense to me. And I'm asking myself, what am I missing, or what are we missing? And I just can't see it. I just think it's one of those things where the market's just not really interested in small caps at the moment. And the fund managers like us who have already got their positions in these small caps can't buy anymore. So until new investors get the confidence to come looking for these small caps, they're probably just going to sit there. But, that's the price we have to pay. Frontier is different because Frontier is in frontier markets. There's a chance that World War III is sort of opening up on in the neighborhood of some of these areas, but the future is not in Pakistan, and I'd actually say the valuation incorporates negative value for Pakistan.
Right.
Like that's how bad it is. So if Pakistan comes back and you end up getting $200 or $300 million for it, I mean, you can buy the whole of Frontier for $170 million. Yeah. So if that comes back, there's a source of value that's potentially almost twice what Frontier is worth. But the Latin American business is just in a market that no one wants to invest in at the moment. Like there's currency risk, there's all these things, but I just think it's so cheap at the moment that even if there's currencies fall, as long as the businesses do what I think they're going to do and mature and become much more profitable, which they're starting to do, then it's still worth 2 to 3 times. So, but the sort of half a dozen contrarian fund managers like us that own Frontier, we can't buy anymore. It's sort of got to the point where it's so small and liquid now, we can't buy anymore. So, and I can tell you from experience, recent experience where we tried to buy a few more shares for the fund, there's no liquidity in this stock at the moment. We can't buy any more stocks. There's no one to buy any from. So if confidence comes back to a stock like this, and say a fund manager wants to buy a 3 or 4% stake in their fund, like this is going to double or triple almost instantly because there's just no shares to buy. But I don't know when it's going to happen. I don't know when the market gets confident with Frontier. But the results are good, and I have my view on this company hasn't changed. The worst thing that's happened is just that the Pakistan business has suffered because the Pakistan economy is genuinely suffering, but everything else is going well. So hopefully we'll get our returns for that at some point. But it's not just Frontier. Like if it was just Frontier, and I'd really question myself, like, am I so biased? Have I lost my mind? Like, am I the crazy one here? But the fact that other sensible value fund managers like us that I respect own it also. And I can see the business has turned a corner recently. Like the numbers are there. You can see this is a far better business now than what it was even 2 years ago. So I don't think it's that I'm crazy. I think it's just like there's a couple of micro caps I was covering. Unfortunately, I didn't own them. But recently they made announcements and their stock prices tripled.
Yeah.
Like this is the value at the micro cap end at the moment. And just fund managers, like people are taking money out of these micro cap funds. The performance is terrible. No one wants to own these stocks at any price. And so that's what you're seeing at the moment. So this poor performance that we're having at the moment, to me, I've asked myself every question, what are we doing wrong? And it's not that. It's just the cyclical element of the market is people want big and safe.
So it's indiscriminate selling of small caps. Absolutely, and of course, the baby gets thrown out with the bathwater there where you've got some high quality opportunities available as well.
Yeah, absolutely. Like if it was just 1 or 2 stocks, it was just us. Yeah. I'd tell you, like I've lost my mind. We're picking the wrong stocks. I'm fully happy to admit that. But that's just not what it is. You're seeing it across the sector. You're seeing it in the US. It's in your face. So we've just got to pick off the best ones that we can. And we know that at some point the market will change and they'll come looking for proper, good investment ideas. But by the time they come looking, these stocks will be up 20 or 30%. But we cannot afford to miss that. We need to be there now while the value's there. And if we have to continue suffering for another 12 months, 18 months, 2 years, I don't know what it is, but we have to, because that's what you're paying us for. You're paying us to suffer to buy the value. And I know it's painful. I know we all want to be in an outperforming fund, But this is value investing. And if you can't do this, you shouldn't be in the game, and you can't be charging people a fee for it. Okay, so this is really the last major topic I want to spend some time on. So again, you talk about the underperformance of the fund. Well, some of that's come from these stocks because we've owned both of them, or all three of them. So you've probably heard of the Ozempic effect, or the new weight loss drugs, the new miracle weight loss drugs, and they've absolutely smashed ResMed's share price. I'll show you some charts in a minute, but ResMed's valuation hasn't been this low in 8 years, and CSL's valuation hasn't been this low in at least 5. Sonic Healthcare has also been vaguely considered to be someone who's not going to benefit from a mass adoption of these weight loss drugs, because if you've got better healthcare, like if we've got better health, then you shouldn't need as many tests done.
Shouldn't be reliant on that.
Correct. But I think that's overdone. Sonic is never extremely cheap as a business, but if we can get 8 or 9% annually out of a really steady business like this, who took, I can't remember, it was $1.5 billion in revenue or profit, but it was an enormous number, whatever it was, that they took during COVID, and then they made some acquisitions, that they wouldn't have been able to make those acquisitions without that sort of one-off money. I think that's underappreciated by the market. CSL and ResMed are more directly impacted by these weight loss drugs. So ResMed's a big one, but I'll just quickly talk on to CSL is really through the Vifor business, through their kidney business they've acquired. So now it looks like they've probably overpaid for that. So now the market's a bit down on that, because CSL has really been probably the most darling stock of the last 15 years. It could do no wrong. And now people are finally starting to question it. But part of the reason the share price has gone down is because people are now just acknowledging that when it was trading at 40-something times earnings was ridiculous. And you're seeing some people complaining at the annual meeting, not about the performance of the actual business or anything, that management has done, but rather just, the share price isn't $330 anymore. Well, it shouldn't have been there in the first place. It's just people getting greedy. Like, they've done so well, like getting from, I think it was $32 when we recommended it back in 2009. I never thought it was going to get to 230 or 250, yet alone 330. So anyone who's owned it for the long term has done great. Like, be appreciative of the gains. Stocks, don't grow to the sky. So some of that commentary was pretty silly in my view. Valuations matter, but the one who's actually been impacted the most, or potentially will be impacted the most, is ResMed, because people being overweight is one of the biggest causes of sleep apnea. So it's a direct correlation. It's not the only thing though. And the reason we've increased our stake in ResMed, or at least bought more to maintain the position sizing, is because we think it's overblown. There are a lot of other reasons why people have sleep apnea, and there's a lot of side effects from these drugs, these weight loss drugs,
and a lot that we don't know of yet as well, potentially.
Absolutely. And one of the reasons actually ResMed doesn't grow even faster than it already has is because there are limits to how many people it can test in a year. So what we actually, what our theory is that even if the weight loss drugs help some people, that just means a lot of these other untreated people for sleep apnea are going to get tested, and therefore will fill up the testing ranks anyway. So it really shouldn't make a hell of a lot of difference to ResMed. But even if it slows ResMed down, like the worst estimates we've seen by anyone so far, like obviously it can always change, is that maybe the growth slows by a couple of percent. But when you're only paying 20 times earnings for the stock, you don't need like 10% growth anymore. You only need 5% growth. So at the moment, we're very confident ResMed can do at least 5% growth over the long term. So we're really happy with the Ozempic effect, because it's allowed us to buy these great companies at great prices. And we've finally been able to do something which I've wanted to do for a long time, which is essentially hedge out our CSL exposure. So we've matched the CSL is about a 6 or 7% position in the index, and now we're the same. So because I don't want to be short CSL, like I'm happy to be underweight the iron ore miners, for example, or the banks. I don't really want to be underweight CSL at a good price, but it's been too expensive to do that. So that's like where some of the underperformances come from these businesses, where I don't think we've made a mistake. We've just owned these great businesses, and their multiples have come down for either because interest rates have gone up or for industry specific reasons. And now we've been able to buy more. So again, I'm happy for the opportunity, but it makes our short-term returns look poor. But hopefully it should be good long-term. And the other general point I just want to make on this is all the talk at the moment is around the macro interest rates and like how many people went and bought all these healthcare stocks, paid astronomical valuations for them because they thought that was a great place to hide from the higher interest rates and the macro environment. And look at how that's worked. So again, like you've got to stay focused on the company and the industry fundamentals, always. And so that's what we do. But again, that's like why you underperform sometimes. You're out of sync with the market. Like we're not buying the iron ore miners because we don't think there's any value there. It's like we're surprised that they've held up as well as they have. But I think it's because of the dividends. But the reason the dividends are so high, the yield so high, is because we think there's a big increase in supply coming and we don't think the current iron ore price is sustainable. So we don't want to buy into that. Yes, it might help you for a year or two and you look great, but then you look back, like I've mentioned, all these people at the moment look back on their bank stocks and go in 2014, like I used to get laughed out of the room telling people that the salad days of the banks were over, laughed at. And they said, oh yeah, we've heard this all before. And here we are 9 years later. And I was right. They're like, you haven't made any capital gains. And now you actually haven't made any capital gains for nearly 20 years in NAB, I think. So some of this stuff happens really slowly, but the quicker you recognize it, the quicker you can buy the right stocks for the next 10 years. And that's all I care about at the moment. Like this period of adjustment to higher interest rates is going to be with us for a long time. Like this isn't going to be over in a year or two. This is going to be with us for 5 to 10 years. But don't worry about it. Like just find the best stocks you can for the next 10 years. That's all I care about at the moment. So if you see me talking too much about the macro or anything, like it's time to take your money out. I've lost my marbles. But all I care about is the team is working on the best opportunities we can find at the moment. And again, the portfolio hasn't looked this good, I think, since the COVID bear market.
Excellent. All right, we'll just jump back to the presentation. I think you've got some slides on CSL and ResMed actually demonstrating their current values.
Yes, and now I've just realised that I'm in control of the slides. So this is the price to earnings ratio for CSL going back to, I think it's 94 or something like that. It's a bit hard to see on there. But you can see it's actually been fairly consistent since early 2000s, around that sort of 25 or to 20 multiple, which has been, which I think is a fair price to be paying for CSL. And you can see the craziness just over the last 3 years where it really got well above that. And so we've patiently waited for it to come back, and now we've had our chance. And ResMed, it looks even better. Like you see how crazy that got. Like it was just, it's really like CSL and ResMed like highlight just how crazy the market was 2 years ago. But go and look at some of the tech stocks in America and stuff, and it's just wild. Like some of these stocks are down 80 or 90% and still with multiple like $10 billion market values, and they're down 80 or 90% and they still look expensive. Like it's just, well, we're going to look back at that 2021, that post-COVID or that COVID period, as like they're going to be writing about that in the history books about just how crazy that was. So I'm really glad we've been patient, and now we've got some great opportunities. So I don't think we really need to go back through this again. There is one point I want to make about how ETFs work, particularly for those people who aren't very familiar with them. But it's just that third point. A lot of people look at the trading in the ETF on the market, and they see not very many units get traded, and they think, oh, the fund's really illiquid, and they worry. And it's not like that at all. Like the trading on market is just the buying and selling of the units. It's got nothing to do with the liquidity of the fund.
No, and but on top of that as well, there is a market maker in the market. So we employ Citibank as our market maker. So when you're looking at your ComSec screen or your NAB trade screen or whatever it might be, and you're looking at the depth, the easiest way, and it's actually quite easy to tell with our active ETFs, is to look for it. The market maker always sits in the market with 100,000 units, just on the buy side and the sell side. And so the net asset value sits in the middle, and the market maker will be, I think it's 0.5 cent above and 0.5 cent below the current net asset value. And if you ever want to know what the net asset value is, just jump onto each fund's website. So you go to the intelligentinvestor.com.au, there's a section called funds. In the drop-down list, they've got all the funds there, and you can go to the key facts section, and the net asset value of the funds is actually updated every single minute of the day that the markets are open. So you know the NAV, and then you will know that the market maker is 0.5 cent above and 0.5 cent below on the buy and sell side. So that's, you're buying units directly off the market maker then, and there's always 100,000 units available. If you're coming in with an order above that, the market maker will generate more units on the spot.
And from the portfolio perspective, we are beholden to the ASX liquidity rules, which are extremely strict. and it really means we can only own 2 or 3 small caps. And I find that really tough sometimes, and but that liquidity is there for a reason. And the other thing is the average market cap. I think I haven't actually looked very recently, but normally the average market cap of our funds for the stock in a portfolio is something like $5 billion or something. So this is never going to be a small cap fund, despite the fact I've highlighted a bunch of smaller cap stocks where I think is the value at the moment. This is always going to be a portfolio that's full of hopefully Australia's biggest and best stocks. And that's why I'm so happy that we've been able to buy Mineral Resources, CSL, ResMed, and Wesfarmers, like some of these great big businesses that are extremely liquid at great prices, because it doesn't happen very often. So we really need to make the most of it.
So perhaps, Tom, we can, Tom's our producer on the side, everyone. Tom, we can jump to a few questions that might have been coming through now.
Yeah, Tom's been demoted.
Yeah, Tom usually is in my seat. Another one from Grant. Would you feel this fund offers enough diversification instead of investing in overseas ETFs that you offer in some of the other funds? So what Grant's referring to here is the InvestSmart diversified portfolios. When I'm talking to people about the InvestSmart approach, which invests in a portfolio of ETFs to give you that really broad diversification, passive index tracking, and then we talk about the intelligent investor funds, I don't think it's an either or type of question. I think especially for people taking a core and satellite approach to investing, you take your core as those passive ETFs, but something like the Intelligent Investor Ethical Share Fund can really play a great role as that satellite investment to provide you with that future potential outperformance. So regarding diversification, the Intelligent Investor Ethical Share Fund is very much Australian equities. It does have companies that are generating revenue overseas, though.
Yeah, I think there's that. The other thing I'd say is, again, like this is my personal view, and I wouldn't ever encourage anyone to put all their money in one fund. I don't think anyone ever would. But this is a portfolio of exceptional quality. It's arguably the safest portfolio I've ever managed. And this is a fund, like I'd be more than happy to tell my friends and family to put large licks of their savings, lifelong savings, in a fund like this. Like, it's just such high quality. I think it's going to do better than the index. And I actually think it's probably safer than in the index. I think even if you looked at the statistical variance, it actually wouldn't be that far off the INES miners and the banks over time. I haven't actually tested it, but it would be pretty close. But it offers potentially much better returns. Again, that's just a personal point of view, but we designed these portfolios specifically for people to feel very comfortable, to have very sleepless nights, sleepful nights, to have very well-rested nights, because I don't have to worry about it. Like, that's why they are all cap funds. If these were small cap funds, I'd say, look, make sure you only have 15 to 20% of your total savings in this fund, for example. But that's not what these funds were designed for. But that's also why we can't do 5 or 6%, better than the index. Like, even small caps don't do that, funnily enough. But that's why I think 2 to 4% is where we should be aiming. If we're not doing 2%, I feel like we've failed, even though most fund managers would be absolutely delighted with that. And it puts you in an elite company. But I think for a fund like this, I'm always aiming for 2 to 4%, because we're not managing billions of dollars. We can own a few small caps. We've been doing this a long time, and I just expect those returns from us as a team.
Really important question up on the screen now. Just to paraphrase, this investor invested in a previous offer in May 22, which we've touched upon in this presentation. Since he had got a great dividend that year, where that year the dividend was amazing because we had a lot of takeovers. We took a lot of profit from that COVID rally. And so that got returned to investors in a distribution. So the distributions are made up of income paid from the stocks, but also realized capital gains from the portfolio as well. And so he says, since then, I've had a significant capital loss. Why would he participate in another offer? And once again, it's important to note that a lot of people that do participate in these secondary offers that we do are existing investors. They find that, yes, they know they can go on market and buy units of this on market. They actually tell us that these secondary offers are a great reminder. Oh, I should have a look at that, and I might top up some in the off-market offer. But what would you say to people who did participate in that offer? They've been through that experience, and they're looking at this one going, well, scratching their head, why would they participate?
Yep. So the first thing I'd say, if you don't believe that we can outperform, then you should not have $1 invested in this fund. To me, that is all that matters. Can we outperform safely over the long term? And we've been around for a long time and we haven't let anyone down yet. And as I talked about, for anyone who watched the income fund offer before, like in that fund, basically when I got back to the business, that fund was 26% behind the index in wasn't even 2 months, I think it was like 6 weeks. And that was probably the first time in my career I thought, I'm not 100% sure how we're going to get that back right at the minute. And we did, and we actually got more than that back.
But it didn't happen overnight.
No, it didn't happen overnight. We got the COVID bear market, and then we bought the coal stocks, and eventually we ended up not only getting that 26% back, but I think we got like another 5 to 10% on top of that. So it was massive outperformance. It was like 36% outperformance in an income fund over 3 or 4 years. So it just shows you how lumpy the process is. Like, this is why most people aren't value investors, because they can't handle it. Like, the only way to outperform over the long term is to have lumpy returns. You buy the discount, you wear the pain, you don't know how long it's going to go for, but you sit there and suffer. And then all of a sudden, gradually, the confidence comes back to those value stocks. And then all of a sudden you find yourself over 5, 6 years or whatever it is, you've outperformed, but we just don't know what the timing is. But we've always delivered over the last 23 years. We haven't let anyone down yet, but and I think I've done a pretty good job of talking through where the cyclical element of the market is at the moment. Like, people just want big and safe, and that's not where the value is. So I don't know how long we're going to have to underperform for, but I don't want to tell anyone to put money in iron ore miners and banks, because I just don't believe that's where you're going to get good return. Like, I just couldn't do it. I believe in this fund, but if you don't, don't put your money into it. We only want money from people who believe in us.
And people should come to these funds with the recommended time frame in mind. All of the funds have a recommended time frame of 5 to 7 years, and that's because of the cyclical nature. And when we talk to people, we do discuss. I do try and say to them, the per annum returns that since inception per annum return hides the volatility. You look at that and go, well, that's a great number, but you very rarely will you actually get that number on an annual basis. It'll be 1 year, it'll be 15%. The next, it might be a negative 2%, etc. It'll really jump around. It's an active fund, and the returns are going to be different from an index.
The other thing is too, like, I feel like I'm a little bit trying to apologise and assuage people's fears about the recent underperformance, but the fund has still delivered 2% outperformance since we started. Like, most fund managers out there would give their right leg to have that sort of performance, right? So there's actually been nothing wrong with the performance. It's just been really lumpy, where we just got out of the gates with that COVID bear market really quickly, and we locked in a lot of profit from that. We did really well. We sold things. We got takeovers for 2 of our biggest positions, and then we protected people's money when the sort of initial downturn came. But the downturn didn't last very long, and valuations haven't really been cheap across the board. Like, if it's a very small proportion of stocks that have actually done well. So it looks like we've underperformed and we've had mistakes or whatever, but it hasn't really been that. It's just been, we've just had to wear this compression in price to earnings multiples. And again, I said, like, we haven't actually done anything wrong, but if you're going to have outperformance, at some point you've got to be underperformed. So this is a cycle we're going through, but the confidence that I have is I just look at the stocks. Like, whether you invest with us at the moment or you invest in another fund manager, like, don't be looking at the performance numbers. This is not the time for that. And we can appreciate the numbers later on, but this is the time to make sure you've got a portfolio position for the next 10 years. Because a lot of these stocks aren't going to get much cheaper, if they get cheaper at all. And they're not everywhere. This isn't like the GFC where everything's cheap and you can just buy anything and everything and do well. It's not like that. Most of the market is extraordinarily expensive and is going to provide terrible returns for people. But a lot of them won't wake up to that until 7 or 8 years later, when they go, oh yeah, Nathan was right. Yeah, the returns have been poor. Yeah, I've got my dividend, but I've really lagged the market because I didn't want to wear that pain, or I didn't know what stocks to buy. So that's what this fund is. I just look through the 20 odd stocks that we own, and I just like it. I'm just so much more relaxed, like the macro stuff, it's stressful. And as a portfolio manager, you're supposed to have all the answers for all this stuff, and it's unknowable. We've never been in this position before where we've had so much government debt this quantitative tightening that hasn't really started yet, and we've never had interest rates rise so quickly. No one knows what's going to happen. Like, everyone's sort of sitting on the edge of their seat. But what I do know is I know these businesses as a group are going to do great. I'm confident now. I know that it's much easier to work out than what's going to happen in the macro environment. I just don't know when we're going to get the returns.
Yeah, that's it. And that's why timing the market is incredibly difficult. No one can do it successfully over the long term. So let's jump to a quick question here. This is a quick one. Is there any other charges to buy into the fund? Through the secondary offer, there's no other charges. You will avoid the brokerage charge, and you'll avoid the buy-sell spread, which happens on market. There's no other additional costs, and that's why a lot of people really do participate time and time again in these secondary offers that we do. Absolutely, you can buy on market. But you do get a few extra units for your money's worth if you participate in the secondary offer. Well, we might look to wrap it up there. Thank you, everyone, for joining us in this webinar. If you do have questions, please still send them through to invest@investsmart.com.au. Jump onto the Intelligent Investor website as well, and you'll find the chat function in the bottom right-hand corner. We man that live. We are real humans man it. We'll send the questions through to Nathan. But please go and check out. You've got the website there on the screen right now, intelligentinvestor.com.au/INES offer. Go there and you can start to complete your application. For those people transferring funds, please be aware of your bank transfer limits. We hate to see people leave it to the last minute and find out they've got a transfer limit in place and can only fund, say, half of their application. That happens more often than not, so be wary of that. But once again, thank you for joining us. If you have any questions, send them through, and we'll be back next quarter with another webinar with Nathan.
Yeah, thanks to everyone for joining in, and also thank you to everyone that's invested with us and supports us through this period, because if we don't have patient investors that are prepared to underperform in the short term, then we can't make the investment decisions that we are today. So thank you very much. And for anyone new, please get on the website. If you've got any questions or whatever, make sure you send them in, and we'll be more than happy to answer them.
Thanks, everyone.